I think at the moment they'd be happy with an agreement of tariffs because it shows progress. And so from that perspective, I think that, yes, whether to be a deal that took March 1st off the table, I think the market would take that very positively. The problem is at the moment, of course, there's little sign of that really happening. I mean, most of the messaging around structural reform, most of the messaging around IP has all continued to be, as Wilbur Ross said, we're miles and miles away. And so from that perspective, I think the market expectations that there's going to be anything radical coming out soon are probably fairly low. Reading whether there actually is going to be a deal or not, I think is incredibly difficult because within that, again, you've got domestic politics on both sides. On the Chinese side, you have the slowdown taking place and everything impacts there. And from the US side, you have the impact of what's happening with the government shutdown. And of course, we're only 18 months away from the start of the presidential races. So, from that perspective, again, there's an awful lot starts to filter in.
And to that point about the political pressure, particularly on the U.S. side, the fact that we've now seen President Trump effectively concede temporarily to Congress on the border front, does this make him more likely to stick to his hard red lines on China as he goes into these negotiations? Well,
I was thinking about that coming in this morning, and actually I could come up with really good arguments in either direction because it depends. If he's concerned that maybe he's seen as being too conciliatory, that, in terms of what's just happened with the shutdown, then taking a hard line with China could be the way forward. Alternatively, he could feel, I want to get a big victory here right now and have something in the headlines. Having something that says, we've struck a deal with China could be the right way forward. Either way could work out. I really don't know.
It seems he needs the victory, though, in light of the opinion polls in the aftermath of giving in, if you will, on the shutdown.
Well, and that could well be the case, but it's how you define the victory. I really don't know.
Simon, what are you looking out for in the way of the emerging market currencies that are so vulnerable to the Chinese growth story? Plus, not just the emerging market currencies, if you think about the Aussie dollar pairing too.
Yeah, absolutely. Well, so first things first, I mean, the Fed put is, as I said, has an incredibly strong impact outside of the US. And so certainly you would expect, if it is successful, to have a significant impact in emerging markets. I think that I would look at it very simply through the prism of China and what's happening with the yuan. If we're right that we're going to end up with a relatively stable currency, then that is great news for local markets. One of the things you saw last spring and summer was a surprisingly wide impact from the weakening of the yuan on other markets. There was one point when the Nikkei actually was reacting more to the weakness in the yuan than weakness in the dollar, which is really quite astonishing. And so therefore, I would also expect to see, not just direct markets like Malaysia and South Korea reacting, but I expect to see some of the larger regional markets getting a positive boost, including Japanese equities, and certainly still everybody's favorite when it comes to Greater China, the Aussie dollar.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.